The story of Ferranti's collapse is not a story about incompetence or bad luck. It is a story about how capital can be weaponized by deception and how trust, once broken, can bring down even the most powerful institutions. To understand what happened, we must first go back to where it all began, a company that was once the pride of British engineering. Ferranti was founded in 1885 by Sebastian Ziani de Ferranti, an Italian-born electrical engineer who would transform the face of modern Britain. For over a century, the company was synonymous with progress and innovation. They powered Britain's electrical grid. They built the radar systems that helped defend the nation during World War II. They became a pillar of the UK's defence industry, trusted with some of the most sensitive military projects in the country. By the time the 1980s arrived, Ferranti was not just a company, it was an institution, a symbol of British engineering excellence and national pride. However, the 1980s brought new challenges that threatened to shake the company's position. The defense industry was changing rapidly. Cold War spending patterns were shifting. Competition was increasing from larger, more aggressive competitors. Profit margins were tightening as the market became more crowded. The company's leadership realized that to survive and grow, they would need to expand beyond their traditional British and European markets. They needed to break into the American defense market, the largest and most lucrative in the world. This ambition was not unreasonable. Many British companies had successfully expanded into America. The challenge was finding the right opportunity. And then, in 1986 and 1987, Ferranti executives discovered what appeared to be the perfect solution, a company called International Signal and Control, or ISC, based in Pennsylvania. On paper, ISC seemed like a dream acquisition. The company claimed to have billions of dollars in defense contracts. They boasted of cutting-edge missile technology and sophisticated guidance systems. They said they had deep connections to the Pentagon and the U.S. military establishment. Their financial statements showed explosive revenue growth. The contracts they claimed to hold were classified, which meant they could not be publicly disclosed or verified in detail. For a defense company seeking expansion into America, ISC appeared to tick every box. This was the key to Ferranti's future growth, or so they believed. In 1987, Ferranti made its move. The company agreed to acquire ISC for approximately $250 million. For context, this was an enormous sum for the time. Ferranti financed this acquisition using borrowed capital and shareholder funds. The deal was announced with great confidence and optimism. Industry observers praised Ferranti's boldness. Investors seemed pleased that the company was taking steps to expand internationally. The financial media covered the acquisition as a strategic masterstroke. Ferranti, they suggested, had finally found a way to crack the American market and join the ranks of truly global defense contractors. But beneath the surface, something was deeply wrong. Unknown to Ferranti's leadership, due diligence teams, auditors, or investors, ISC was not what it claimed to be. The company was systematically creating false revenue. They were reporting contracts that did not exist. They were inventing subsidiaries that had no real operations. They were booking imaginary income and describing phantom projects as if they were real defense contracts. Over time, they would report more than $1 billion in fraudulent revenue. This was not a simple accounting error or a minor case of book cooking. This was industrial-scale fraud, carefully designed and executed with precision. How did such a massive fraud go undetected for so long? The answer lies in how ISC and its founder, James Guerin, exploited the very secrecy that surrounds the defense industry. Because ISC claimed to work on classified military projects, they could point to national security concerns whenever questions arose about their contracts. They could say that details could not be disclosed. They could claim that specific revenue figures were classified. They could hide behind the shield of military secrecy. This made it extraordinarily difficult for anyone to verify their actual business. Auditors could not access classified contract details. Due diligence teams could not independently confirm classified deals. Even the military procurement officers who supposedly authorized these contracts were, in many cases, either non-existent or complicit in the fraud. ISC's management also created a veneer of legitimacy. They hired respected defense industry professionals. They maintained offices in respectable locations. They created detailed financial documents that looked professionally prepared. They operated with enough sophistication that even experienced auditors found nothing obviously wrong. The deception was not crude or obvious. It was subtle, well-organized, and designed specifically to survive initial scrutiny. Ferranti, meanwhile, was consolidating ISC into its corporate structure. The company had committed hundreds of millions of pounds to the acquisition. They had spent capital and credibility on this deal. Senior executives were publicly committed to ISC's success. The company had taken on debt to finance the purchase. All of these factors meant that there was institutional pressure to believe that the acquisition was sound, that due diligence had been done properly, and that the deal would pay off as promised. For 3 years after the acquisition, the fraud continued. ISC continued to report massive revenue gains. Ferranti's consolidated financial statements showed growing profits from the American subsidiary. Shareholders believed that the acquisition was working. Credit rating agencies and lenders saw a company with growing American defense revenues. Everything appeared to be on track. The acquisition seemed vindicated by events. Then, in 1990, U.S. authorities began to investigate ISC. The investigation was not triggered by any internal confession or voluntary disclosure. It came about through the persistence of federal investigators and prosecutors who had noticed irregularities in ISC's government contracts and the suspiciously large sums of money the company was claiming. As the investigation deepened, it became impossible to hide the truth any longer. James Guerin, the founder of ISC, eventually confessed to the fraud. The profits were fake, the contracts were fabricated. The financial statements were fiction. The investigation revealed that ISC had essentially no legitimate revenue. The billions of dollars reported over the years were entirely fictitious. The military contracts that supposedly drove the company's growth did not exist. The subsidiaries that had been set up to execute these contracts had no real operations. Everything every major claimed the company had made was false. When the news broke, the impact on Ferranti was catastrophic. Imagine discovering that the company you just paid $250 million for does not actually generate revenue. Imagine realizing that the acquisition that was supposed to propel you into the American market is actually a complete fraud. That is what Ferranti's leadership faced in 1990. The company's balance sheet, which had appeared strong, suddenly showed that it had paid hundreds of millions of dollars for an asset worth essentially nothing. The financial damage began to compound immediately. ISC's reported profits evaporated from the books. The consolidated revenue figures for Ferranti suddenly dropped. Investors panicked. Once the fraud became public, confidence in Ferranti evaporated almost instantly. Shareholders sold their holdings as stock prices plummeted. Banks and creditors, who had been comfortable lending to Ferranti when it appeared to be growing, suddenly became nervous. Credit lines were tightened. Lending terms became more stringent. The company that had been seen as a model of strategic expansion was suddenly viewed as incompetent or, worse, complicit in a massive fraud. The financial pressure intensified. As Ferranti's share price fell, the company's ability to raise capital in the market disappeared. The company was burning through cash. It was servicing debt on money it had spent on a worthless acquisition. It was trying to maintain operations and pay employees while its market value was collapsing. The situation deteriorated rapidly. By 1991 and 1992, Ferranti's financial condition had become desperate. The company tried to restructure. It attempted to sell off divisions and assets to raise cash. It sought to negotiate with creditors, but none of these efforts could overcome the fundamental problem. Ferranti had made a catastrophic capital allocation decision, and the consequences were irreversible. The company had paid $250 million for something worth zero. That was not a problem that could be solved through operational improvements or cost-cutting. But none of these efforts could overcome the fundamental problem. Ferranti had made a catastrophic capital allocation decision, and the consequences were irreversible. The company had paid $250 million for something worth zero. That was not a problem that could be solved through operational improvements or cost-cutting. By 1993, just 6 years after the ISC acquisition was announced with such fanfare, Ferranti filed for bankruptcy. But beyond the immediate human consequences, the Ferranti collapse reveals something fundamental about how capital works and how dangerous the combination of leverage and fraud can be. Ferranti did not fail because it made a bad business decision in an uncertain environment. It failed because it paid enormous capital for something that did not exist. And because it had used borrowed capital to finance that payment, the losses were multiplied throughout the financial system. This pattern of leverage amplifying losses is critical to understanding financial disasters. When a company uses debt to fund growth, that debt acts as a force multiplier. If the underlying business is sound, then debt can accelerate growth and create tremendous value. But if the underlying business is fraudulent or worthless, then debt accelerates the collapse. The losses are magnified, the impact spreads to creditors, suppliers, and ultimately to the broader economy. The economy entered the worst recession since the Great Depression. The underlying problem was similar to Ferranti's SISC acquisition. Capital was being used to purchase something that did not have the value claimed. The leverage magnified the consequences. The Ferranti collapse also reveals something important about how fraud can survive in complex financial systems. ISC was able to hide its fraud for several years despite professional auditors, due diligence teams, and industry experts reviewing the company. This was not because these professionals were incompetent. It was because ISC exploited several features of the financial environment. They used the secrecy of the defense industry as a shield. They created sophisticated-looking financial documents. They hired experienced professionals to lend legitimacy. They operated within an industry where very large, unusual numbers are normal. They took advantage of the optimism and growth mindset of the 1980s, when ambitious deals were celebrated. Auditors signed off on the financial statements. These were not necessarily careless auditors, but auditors operate within certain constraints. When a company claims that certain revenue comes from classified government contracts, an auditor cannot simply demand to inspect those contracts directly. Modern investors often face similar challenges when evaluating complex opportunities. In the 1980s, Ferranti competed in a global market where falling behind meant decline. The opportunity to enter the American market was attractive, which created pressures that made it easier to accept ISC's story without rigorous questioning. Today, we see similar dynamics in technology companies valued at enormous multiples based on projected revenue. When valuations rest on revenue that does not exist, the consequences for investors can be severe. The Ferranti collapse offers 3 essential lessons for anyone who works in finance, investment, or business. First, due diligence is everything, especially when someone is using secrecy as a shield. If a company is claiming to do valuable work but will not allow verification of that work, that is a warning sign. Secrecy sometimes serves legitimate purposes, but it also creates perfect conditions for fraud. Second, revenue quality matters far more than revenue size. A company generating £1 million in real, sustainable profit is more valuable than a company reporting £1 billion in revenue that cannot be verified or that does not convert to actual cash flow. Growth without verified cash flow is always dangerous. It is a warning sign, not a sign of success. Third, leverage amplifies everything. It amplifies good decisions and bad ones. If the underlying business is sound, leverage can accelerate growth. If the underlying business is weak or fraudulent, leverage accelerates collapse. The real tragedy of Ferranti is not that the company made a mistake. Companies making mistakes is normal. The tragedy is that a century of engineering excellence, of innovation and progress, was destroyed by one decision to use capital to purchase something that did not exist. The company did not fail because its traditional business was declining. It did not fail because of bad management. It failed because capital, the lifeblood of any organization, was spent on an illusion. The question is not whether this type of collapse can happen again. History suggests it can and will. The question is whether investors, auditors, and managers will learn from Ferranti's fate and demand verification, evidence, and honesty before committing capital to any venture, no matter how attractive the story may sound.